Okay. Good evening, guys. Apologies for some technical issue on our end. I hope you all are there. Can you hear me and can you see me and also can you see the screen of the students? Well, there, guys. Yep. I think your messages, participants can chat with. Yes, you can chat with me. Good afternoon. Good evening. We are in the evening, mid of the evening. Okay, so we have covered the ratio analysis topic. We have done all the ratios. Rather, we're just going to now do questions in our today's session. So we'll be covering the questions. Okay. Right, ratios are done. I think a couple of ratios are left that we will do it in today's session. Along with that, we'll be doing the questions that we have. In fact, in the questions also we have done the first question. Then we have also covered question number 4 and 5. Question number 4 and 5 is done. Let's go ahead with this question 2. The assignment file has already been uploaded on the portal. You can have a look at it. Or else I'll be anyways putting the question over here. Let's just get started with this question. Okay. 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 Let's look at this question 2. From the following information, we have to ascertain the amount of long-term loans, reserves and surplus, and capital employed. Capital gearing ratio is 0.75, debt equity ratio is 0.4, and equity share capital is 3 lakh, preference share capital is 1 lakh. Long-term debts to shareholders funds are available. From this information, we have to ascertain long-term loan, reserves and surplus, capital gearing ratio is given, capital employed is given. So let's use one by one ratios. The first ratio is debt equity ratio, capital gearing ratio of 0.75 and also debt equity ratio. And the debt equity they have clearly specified it's long-term debt. Equity share capital is given, preference share capital is given. So let us talk of initially the debt equity ratio or capital gearing ratio for that case. So if you say capital gearing ratio, we know that capital gearing ratio is actually computed as funds which require fixed rate of return upon funds which do not require fixed rate of return. Right? Now, which are the funds that require fixed rate of return? Capital gearing ratio will be debt plus preference share capital upon equity share capital plus reserves. Capital gearing ratio that's given as 0.75. So it will be like 0.75 is equal to 0.75 is equal to debt plus preference share capital. So we don't know the amount of debt. Amount of debt plus preference share capital is given as 1 lakh. Right? Equity share capital is 3 lakh. Now again, we don't know the reserves. Reserves is also something which is unknown to us. Then the next ratio that they've given is debt equity ratio. So let me just take that debt equity ratio into account. Debt equity ratio is long-term debt upon shareholders fund. We'll say debt upon equity share capital plus reserves. So debt equity ratio is 0.4. 0.4 is equal to debt upon equity plus reserves. So we don't know the amount of debt. And again, we don't know what is equity share capital Equity share capital is something we know, which is 3 lakh, but we don't know how much is the amount of reserves. So in both the cases, we are having like a situation where, uh, some value is two things are not known to us. So let's try to just solve this. So this will be like multiply 0.75 into 3 lakh. That will be 2,25,000, right? 0.75 into 3 lakh. So 0.75 into 3 lakh, which is 2,25,000, and plus 0.75 reserves is equal to debt plus 1 lakh, right? So let's keep debt on one side and rest all terms on the other side. So that 1 lakh coming on this side will make it as 1,25,000 plus 0.75 reserves equal to debt. Then 0.4 into 3 lakh, that is 1,20,000 plus 0.4 reserves is equal to debt. This is my equation number one. Equation number two. Let us just equate both of them. And say 1,25,000 plus 0.75 reserves is equal to 1,20,000 plus 0.4 reserves. Take reserves on, take the reserves on one side, all the reserves on one side. You can say here you have left with 5,000 is equal to, there's some problem. There seems to be some problem. Like 25,000 plus that 1 lakh, that will be 0.75 into this 2,25,000 plus reserves into 0.75 equal to debt plus preference share capital is given as 1 lakh. 1 lakh. Denominator it is equity share capital plus reserves. On the other side, you have debt on 3 lakh plus reserves. So 3 lakh into that is debt. Then you have mm, capital gearing ratio 0.7, debt equity ratio is 0.4. Share capital is 3 lakh and preference share capital is 1 lakh. This has 0.75. So minus 0.75 is 1,25,000. 75. So no, there is something going wrong over here. Calculation. Let me just recheck it again. We have capital gearing ratio as 0.75. 0.75 equal to debt plus preference share capital 1 lakh and equity share capital 3 lakh plus reserves. We have debt equity, debt upon equity plus reserves. So debt is not known and 0.4. 0.4 is equal to 3 lakh plus reserves. We have 3 lakh into 0.75, 2,25,000 plus 0.75 reserves is equal to debt plus 1 lakh. Then take 1 lakh on this side, subtract it and make it as 1,25,000 plus 0.75 reserves is debt. Then on this side we have 0.4 into 3 lakh, which is 1,20,000 plus 0.4 reserves is debt. Equating them, we make it as this. They're getting a negative value. There's some problem. 25,000. Y minus 0.75x is 1,25,000. Y minus 0.4x. 0.4x is 1,60,000. So we're making some mistake over here. Okay. So yeah, so that's the problem which we were looking for. So this is long-term debt to shareholders funds. So when you say shareholders funds, we are going to include the preference share capital also over here. The equity share capital plus reserves plus preference share capital. Equity share capital is 3 lakh. We don't know reserves and we also don't know I'm sorry, preference share capital is known to us. Preference share capital is 1 lakh. It will be 4 lakh. Yeah, so this is 1,60,000 plus 0.4 reserve equal to debt. And when you just solve this, 1,60,000 coming on this side, you'll have minus 35,000 equal to 0.4 minus 0.35 reserves. Okay. We get the value of reserves as 1 lakh. Value of reserves is 1 lakh. Now, when we say that reserves is equal to 1 lakh, reserves are equal to 1 lakh, we can definitely calculate the all other aspects also. Now we can say if the value of reserves is 1 lakh, then we'll say substitute in maybe first equation. It will be 1,25,000 plus 0.75 into 1 lakh equal to debt. 1,25,000 plus 75,000, that is 2 lakh. The value of debt is 2 lakh. So I got the value of debt, I got the value of reserves, I got the value of equity. All things are asked. So we need the long-term loans, reserves and surplus. Capital employed is just the total of all of them, right? Reserves is 1 lakh because 35,000 divided by 35,000 divided by 0.35. 35,000 divided by 0.35. Got it, Dhanush? Because you have like 1,25,000 minus 1,60,000, 35. Okay, great. So done with question 2 now. Question number 2 is done. Now let's take up so let us try out this question 14. Try to solve this question 14. These questions are already uploaded. Kiran can get these questions on the viewers portal that's already uploaded. Try out question number 14. And I'll just give you around, I can see, timing wise. Just give you maybe just 5 minutes. Please look at the question, try to understand it, and then start with it. Not uploaded, I've uploaded yesterday only. I'll just check and upload it. But for the time being, you can just see question 14. For the time being, you can just have a look at question 14. Look at the question, try to just solve it in a scribble form. Later on, we'll take it up fully. Okay, so let's get started. Following accounting information and financial ratios of PQ are related to the year end 31st March 2000, 31st December 2006. We have gross profit given, net profit is given, raw material consumed is 20% of works cost, direct wages is 10% of works cost, stock of material is 3 months usage, finished goods stock is 6% of the works cost, debt collection period is 60 days. All sales are on credit. So ratios we say fixed asset to sales, fixed asset to current assets, and then current ratio, long-term loan to current liabilities, capital to reserves. All this, if you observe one particular aspect, not a single number is given. Everything is in terms of ratios and percentages. The one number that they've given us is the fixed asset value of 26 lakh. Now, based on this one number, we have to derive all other numbers in a connecting manner. We have to prepare a P&L and also the balance sheet as on 31st December 2006. So let's talk of P&L and also the balance sheet. We'll just have it side by side. P&L generally will prepare it in the vertical form for the ease of understanding and for the ease of solving it. So let's say we'll start with sales. From that, we are going to subtract gross profit. I'm sorry, COGS will give us gross profit. Then we have net profit is also to be computed. Now, there's no other information about other costs like direct wages. Wages are given, but that will anyways a part of COGS. There's no other expense specifically given to us. We'll say less other expenses because we do have a long-term debt, but again the loan on that is not specified to us. We'll just say other expenses. We have the tax rate given to us? No. Then we'll simply say the net profit figure. Okay, that's the vertical P&L. Then in the T form balance sheet, let's try to fit in as much values as we can. So in the balance sheet, we have fixed assets, current assets, right here, fixed assets, current assets, fixed asset to sales, fixed asset to current assets. Then we have long-term loan to current liabilities. So we will definitely have the current current liabilities, long-term loan to current liabilities, capital to reserves and surplus, capital and reserves, and we have long-term debt available also. Long-term debt. And then we have in that debt collection period, stock is also there. I need to specify that part in current assets. Current assets will have inventory, inventory, and we have debtors, and then finally other current assets. Okay. Sales, COGS, gross profit, other expense, net profit, capital reserves. So these are the items that we need to compute. Let's use the ratios one by one. First up, we have the information of gross profit, which is 15% of sales. And we don't know the value of sales as such, right? But yes, we know the value of fixed asset is 26 lakh. Do we have any ratio which is connecting with fixed assets? Any ratio that is connected with fixed assets in the question? Yes. Fixed asset to sales. And also fixed asset to current assets. So let's use the fixed asset to sales because from that we'll get the sales value. From that, again, we can get the gross profit and COGS. First ratio that we're using is fixed asset to sales. Fixed asset to sales is 1:3. Therefore, fixed asset upon sales is 1/3. Fixed asset to sales is 1/3. So what is the value of fixed asset? Uh, Fixed asset value is given in the question as 26 lakhs. We have 26 lakh on sales is 1/3. Therefore, value of sales is going to be 78 lakhs. Perfect. So we got the value of sales. Sales is 78 lakhs. Then what about COGS? With regards to COGS, the question is specifying a GP ratio of 15% of sales. So gross profit is 15% of sales. This is going to be 15% of 78 lakhs. How much is gross profit? 15% of 78 lakhs. 78 lakh into 15%, which is 11 lakh 70,000. Gross profit is 11 lakh 70,000. What is COGS? Minus 78 lakh, which is 66 lakh 30,000 as the balancing figure. Right? So I'll obviously write here. COGS is 78 lakh sales minus a gross profit of 11 lakh 70,000. 66 lakh 30,000. COGS is 78 lakh minus 11 lakh 70, which is 66 lakh 30,000. Okay, so that is done. After this, COGS, what about other expenses and net profit? So we have information about net profit of the question. Net profit is 8% of sales. Net profit is 8% of sales. So let's get that number. Net profit is 8% of sales, which is 8 by 100 into sales of 78 lakhs. 78 lakhs, 8%, that is 6 lakh 24,000. Net profit is 6 lakh 24,000. So if net profit is 6 lakh 24,000, of course, the other expenses is going to be a balancing figure is 5 lakh 46,000. Okay. So P&L is complete. Now we have to go for the balance sheet. Now, even in balance sheet, we know the value of the fixed asset is 26 lakh. And they're stating that current assets is current ratio is 2 is to 1, and the fixed asset to current asset is 13 is to 11. So let me use that ratio. Fixed asset to current asset. Fixed asset to current asset 13 is to 11. Fixed asset value is 26 lakh. 26 lakh is to current asset. So what will be the value of current asset, guys? What's the value of current assets? Yeah, 22 lakhs. Perfect. Remember, this is the total current assets that we are talking about. We need to calculate the individual value. Okay. That will calculate using the other ratios. Fine. So we got the current ratio. Now, sorry, current assets. Now the time is to calculate the current ratio. I will use the current ratio. Current ratio is computed as current assets upon current liabilities. Current assets upon current liabilities, we say current asset to current is 2 is to 1. The current asset is 22 lakhs on a current liability of 2. Therefore, what is the current liability amount? The amount of current liabilities, 11 lakh. Current liabilities is 11 lakh. Okay. Current liabilities is 11 lakh. Then long-term loan to current liabilities ratio is given. From this, we can get the amount of long-term loan. Long-term loan to current liabilities. Long-term loan to long-term loan to current liabilities is 2 is to 1. Therefore, what is the value of long-term loan? We don't know. We can definitely say that is 2 into current liability of 11 lakh. Now, 2 into 11 lakh will be definitely 22 lakhs. So long-term debt works out to be 22 lakhs. Okay. Next ratio, long-term loan to current liability. Capital to reserves and surplus is given to us. Right? So I think capital to reserves and surplus is given. And apart from that, we have like raw material consumed, direct wages, stock of raw material is given, stock of finished goods is given. So debt collection period is given. So I need to actually give a more detailed classification of these items because inventory will include raw material and also finished goods. Raw material and finished goods will need the raw material stock to be stated, finished goods stock to be stated, raw material stock, finished goods stock. We need to get the value of debtors, and then we can say the balancing figure may be others. So total we say current liability, current assets. Total current asset was 22 lakhs. Okay. Then we have the raw material stock, finished goods stock. All of this is going to be computed. But How do we go about this? 60% of works cost is your finished goods stock, 3 months usage is stock of raw material. Now, how do we get that works cost? So let us assume that whatever COGS we have got, that's actually your works cost. So COGS is basically your works cost. So I can debt the stock of finished goods as three, sorry, 60%, 6% of works cost. Stock of finished goods is 6% of works cost. That is 6 upon 100 into works cost. Now, works cost is your COGS, which is 66 lakh 30. 66 lakh 30,000 into 6%, 3 lakh 97 800. We got the stock of finished goods at 6 lakh 90, 3 lakh 97. 3 lakh 97 800. That's the stock of finished goods. The stock of finished goods 3 lakh 97 800 आ गया. Then stock of raw material. Raw material stock. How much is the raw material stock given? Raw material stock is 3 months usage. Okay. So that is 3 months usage. That's going to be like 3 months of usage. So we need to get first the usage or raw material consumption. So raw material usage is 20% of works cost. 20 upon 100 into works cost is COGS is 66 lakh 30. 6 lakh 30 into 20%. Raw material usage is 13 lakh 26,000. Based on this raw material usage, we can get the stock of raw material. Stock of raw material will be raw material usage, which is 13 lakh 26,000 into 3 months. So that's going to be into 3 by 12. 13 lakh 26,000 into 3 by 12. 3 lakh 31 500. Right? Stock of raw material is 3 lakh 31 500. Now, receivables, debt collection period is given in the question to be 60 days. And debt collection period is assumed to be 60 days. How do we get the debtors collection period? Debtors collection period. How do we compute this debtors collection period? That's going to be debtor upon annual sales into 360. Let's take the amount of debtors to be. So debtor is debt collection period is, and it is given as 60. You can assume 365 days also, but is the question specified anything? No, but you can assume 365. Let's assume this is 365 to be more appropriate. This is 60. Now, we want to know the debtor value. Annual sales will be, what is the annual sales? 26 lakh, right? No, 78 lakh. Yes, therefore, what will be the value of debtor? Amount of debtor? How much is it? That will be 78 lakhs into 60 by 365. So value of debtor is 12 lakh 82 192. So debtor is 12 lakh 82 192. Now you can get the balancing figure over here is 3 lakh 31 500 plus 3 lakh 97 800 plus 12 lakh 82 192 is 20 lakh 11,000 minus 22 lakhs. So that's difference is 188,508. 188,508. That's your other current assets. Okay. Got the value of debtors and other current assets. Now only one thing is left, which is capital to reserves of 1 is to 4. Now that is something which we can easily get by simply looking at the balance sheet. Total liabilities will be equal to total assets, which is equal to total liabilities is equal to total assets, which is further equal to total liabilities. Total will be further equal to total. What's the total assets or liabilities? Can definitely say that total liability comprise of equity share capital plus reserves plus 22 lakh plus 11 lakh. 22 lakh plus 11 lakh is equal to total assets. What's the value of total assets? 26 lakh plus 22 lakh. That is 26 lakh plus 22 lakh. We can say equity share capital plus reserve plus 33 lakh is equal to 48 lakh. We can say equity share capital plus reserves. This comes out to be 15 lakhs. Now this has to be distributed between equity share capital and reserves in the ratio of 1 is to 4, capital and reserves. This is going to be distributed in capital and reserve in the ratio of 1 is to 4. 1 is to 4 means capital is 3 lakh and reserves is 12 lakhs. Capital is 3 lakh. Reserves is 12 lakh. Okay. That's how the balance sheet and P&L is complete. Did we get this, guys? Yep. Okay. Would you like to solve another question on your own? The full question has to be solved by you. Will you be able to solve it? Now we're making it like not only balance sheet, but balance sheet and P&L. Both things we are looking at together. Yeah. Okay. Then let us take up. Okay. Try out this question number 13 now. Start with question number 13. Try to solve it. Try to solve this question number 13, guys. What should be taken as total liabilities? Total liabilities will be same these items. Share capital is 50%, right? So there is no change in the paid of share capital. It is going to be 50% of the total capital. 5 lakh is 50% total capital. Of course, total capital is 10 lakh, right? is given 7% debentures, 10% of the total liabilities. We must get the total liabilities amount by taking this 5 lakh as 50%. 5 lakh by 50% should be 10 lakh. Out of the 10 lakh, uh, debentures will be 10%. Basically, 1 lakh. Okay, done. We're done with the solution, guys. Now, let me quickly solve it for you. We're supposed to prepare P&L and balance sheet, or I'll just do one thing. I'll just put up the solution in front of you. This is question number 13. Right? Yeah. First, have a look at the balance sheet. Is it matching? Let's have a look at the balance sheet. Pick your answer. Then we look at the detailed solution one by one. Let me start with the solution. As per the question, we have like paid off share capital 5 lakh, and which is representing 50% total liabilities. So of course, total liabilities, we can get it as 5 lakh divided by 50%. Total liabilities is 10 lakh. But that liabilities is going to be distributed in this ratio of 15%, 10%, 25%. All three of them are being identified. Then coming to the other information, uh, with regards to during the year, additional plant and machinery was bought, debentures were issued, and interest being paid on 30th September and 31st March. So initial years we have the debentures, and debenture issued on the first day of the year. Then we have information of during the year ended, the plant and machinery had been bought further, 25,000 depreciation has been written off. Okay. Freehold property remained unchanged. The total fixed assets then constituted 60% of the fixed assets current assets. So during the year, total fixed asset is obviously going to be 60% of fixed asset plus current assets. And of course, when we say fixed asset plus current asset, that's total liabilities, and total liabilities will be equal to total assets. Right? Total asset liabilities are what? So we say 60% of that. So that's like 6 lakh is the fixed asset value. Okay. Now, out of that 6 lakh, 4 lakh is definitely the freehold property. We subtract that freehold property. WDV of the machinery is 2 lakh. We just do the reverse calculation, wherein we say opening plant and machinery cost, we don't know. We would have purchased something and we would have obviously closing machine, which will be the gross. From that, we are going to subtract the depreciation. Opening depreciation is given as 75,000. Opening plant and machinery value is 2 lakh 50. So when we do the WDV of plant and machinery, that's going to be the uh, that's going to be like 2 lakh. So if it is 2 lakh and your purchase was 50,000, closing plant and machinery will be 3 lakh. And if you want the WDV to be 2 lakh, total depreciation should be 1 lakh, which means that your depreciation is going to be 25,000. Then we use the current ratio. Next ratio was current ratio, which is 1 is to 1.6, and quick assets ratio is 1 is to 1. Current ratio is 1.6. Current asset to current liabilities are 1.6. Current asset is 1.6 into current liabilities. Current asset, we got it as 4 lakh because we already know the value of current liability over here. We just the creditor 2 lakh 50,000. And we use the quick ratio to get the value of stock. Quick assets is anyways current asset minus stock, which is 2 lakh 50,000. Then the question says that debtors is 4/5 of quick assets. So quick assets into 4 by 5. Debtors collection period is 2 months, which is obviously computed as 12 upon debtors turnover. That is like sales upon average debtors. Now, why are we using average over here? Because we have the information of opening debtors. All the turnover ratios will use the average number here because we have the information about the opening figures. And I mean, opening debentures, or I'm sorry, opening debtors, opening stock. We have information about all of them. We take the average debtors by taking average of opening and closing. Once we get the sales, when we compute the gross profit, COGS will be obviously the difference between sales and gross profit. Return on net worth is given in the question. Return on net worth is 10%. So when we say return on net worth, that is PAT upon net worth or own funds. PAT of PBT is what we got. And then since we have the PAT of PBT, we can get the EBIT number also by adding interest to PBT. So PBT, profit before tax plus interest, will give you EBIT. You can also put it the other way around. EBIT minus interest will be your PBT. EBIT minus interest will be PBT. So EBIT is basically 72,000. And then operating expenses or gross profit. Operating expenses are basically gross profit minus EBIT, which is 1,35,000 minus the EBIT as a balancing. That will give this particular balance sheet and P&L. This particular solution also I'll be uploading it on the portal. Okay. Did we get this answer? Any issues, any doubts in this question's solution is? Sales. Sales was computed by using debtors turnover. Debtors turnover was, debtors collection period was 2 months. So from that, we got the debtors turnover. Now, those debtors turnover number was used to calculate the sales by taking average debtors in the denominator. Okay. We took help of the debtors collection period or debtors turnover to get the value of sales. Okay, guys. Okay, then let's do one thing. Let's take a break over here now, guys. Break of 15 minutes. Then we'll get started with the next set of questions to be solved in today's class. Okay, so let's take 1 second. What to do when interest on debentures? Interest on debentures will be over here, your income statement. From EBIT, you're going to subtract the interest, right? That interest is going to be used for presentation. Okay, let's take a break, guys. Let's take a break. 13. That's completed. Now let's take up another question. We've done 14th also. This done. The next one that I want you to do is, yeah, question number 19, guys. Try to solve this. We'll assume that all interest is paid in current year only and nothing is outstanding. You're talking of the previous question? Yes, in the previous question, the question was quite clear. They state that interest being paid on 30th September and 31st March. By the end of the year, everything has been paid. The interest has been paid. Okay, Rohan, let's begin with question number 19, guys. Start solving question 19. Again, a 10 minutes for you. Start solving this question 19. Okay. So these are the information given to us: sales, return net worth, rate of income tax, payables, overdraft. Some of the items are given here. How to calculate the operating expense for the year ended 31st March 2021, and then also preparing this particular balance sheet. Right. So balance sheet, again, we have got a lot of figures already given to us. Let me just write down this format. So here we have liabilities. In the liabilities, we have got share capital, right? Then we have reserves and surplus. 15% debentures, payables, and then we have the term loan. The items of liabilities. Then on the assets side, we have fixed assets, current assets, current assets. Then we have the stock, receivables, and cash. That is going to definitely tally. Okay, prepare a balance sheet. Now, out of these, we have got a lot of numbers already. This question. So we have like information about year end 31st March 2021, and we have to prepare this particular, this is not term loan, it's actually bank OD. Bank overdraft. Okay. COGS is given, interest on debentures is given. The receivables, which include 1 lakh 20, including debtors of 2 lakhs. So receivables, we can just write 2 lakhs. Payables is 2 lakh 50,000. These are the items that have been already given to us. And then bank OD is 1 lakh 50,000. Okay. Then we have information of sales, return on net worth, rate of income tax, so on and so forth. Let's start taking the ratios one on one. Now we have the sales number, and along with sales, we have the net profit number. Along with sales, we are having the net profit number. How do we get that net profit number? Net profit percentage. Net profit percentage is net profit to sales is 6.5%. 6.5%. So that is going to be 75 lakh into 6.5%. 75 lakh into 6.5%. So net profit number is 75 lakh into 6.5%, which works out to be 4 lakh 87,500. Okay. So the net profit as 4 lakh 87,500. Now, cost of goods sold is 22 lakh 50,000. Right now, since cost of goods sold is 22 lakh 50,000, we can definitely talk of cost of goods sold is 22 lakh 50,000. We can definitely get the gross profit. Gross profit is sales minus COGS. Sales is 70 5 lakh minus COGS is 22 lakh 50,000. So how much is the gross profit? 52 lakh 50,000. 52 lakh 50,000 is gross profit. Now we know that from gross profit, we subtract the operating expense, which gives us EBIT, earnings before interest and tax. From that, we further subtract interest. Further subtract interest, which gives us profit before tax. From that, we subtract tax, which gives us profit after tax. So gross profit is 52 lakh 50,000. Now we know the net profit number, which is 4 lakh 87,500. What's the tax rate given? What is the amount of tax rate? Any tax rate given? Yes, tax rate is 30%. If tax is at the rate of 30% and your PAT number is 4 lakh 87,500, your profit after tax number is 4 lakh 87,500, tax rate is 30%. So do the reverse calculation, get the PBT number, profit before tax number. Get the profit before tax number, 4 lakh 87,500 is tax rate is 50%. Oh, sorry, yeah. Tax rate is 50%. So of course, if it's 50%, your tax amount will be also 4 lakh 87,500 and your PBT will be 9 lakh 75,000. We have the value of interest given to us. Interest on debentures is 75,000. Interest on debentures is 75,000. So what will be the amount of EBIT, guys? Can you tell me what will be the amount of EBIT? Yeah. Anyone? What is the amount of EBIT? Do the reverse calculation, right? So because from EBIT you would have subtracted interest, which gives you PBT. So doing the reverse calculation, EBIT is 10 lakh 50,000. Now from 10 lakh 50,000, can we get the operating expense number? Operating expense is going to be definitely the balancing figure. Operating expense is 10 lakh 50,000 and 52 lakh 50. The difference between them, this is 52 lakh 50,000 minus 10 lakh 50,000. 52 lakh 50,000 minus 10 lakh 50,000, which is 42 lakhs. Got the value of operating expense as 42 lakhs. The first part of the question is done. Operating expense of 42 lakh 50,000. Now coming to the balance sheet part. In the balance sheet part, we need the stock current. Anyway, this current asset is a header. So let's look at the ratios that we have. Return on net worth is 25%. Now, if the return on net worth is 25%, I have to use the net profit figure. Put iPad on charge. Yeah. So operating expense is done. Now we are going to look for the return on net worth. So return on Net worth. This is computed as profit after tax upon net worth. And that return on net worth number is 25%, is 0.25. PAT is 4,87,500 upon net worth is 0.25. You can say net worth is 4,87,500 divided by 0.25. 19 lakh 50,000. Right. So net worth is 19 lakh 50,000. But wait, what all is included in the net worth? What all do we have in the net worth? So in the net worth, the balance sheet, we can say it has got share capital and the reserves and surplus. Do we have any information about share capital to reserves? Yes. Share capital reserves is 6:4. Right. We'll say since net worth is 19 lakh 50,000, which is equal to share capital plus reserves, and share capital to reserves ratio. Share capital to reserves ratio is 6:4. Okay, so therefore we can say share capital is 1.5 times of reserves. So 19 lakh 50,000 equal to 1.5 times of reserves plus reserves, which is 2.5 times of reserves. What's the value of reserves, guys? What's the value of reserves? 19 lakh 50,000 divided by 2.5 is 7 lakh 80. And share capital will be 1.5 times of reserves. So 1.5 into 7 lakh 80. 1.5, which is 11 lakh 70. We got this filled up as share capital 11 lakh 70,000 and reserves and surplus amounts to, sorry, reserves and surplus is 7 lakh 80,000. Okay, that is done. Current ratio is 2.5. Net profit to sales is used. Now we have to use this current ratio, get the numbers. Now let me use the current ratio formula. Debentures we can get. Debentures, yes, interest on debentures is 75,000. And do we have the amount of interest? Yeah, 15% debentures. Yeah. The value of debentures is interest upon rate of interest. Interest is 75,000 upon 15%. 75,000 upon 15%. 5 lakh, the amount of debentures. Let's just fill it in our balance sheet. 5 lakh is the amount of debentures. Total of liabilities is 28 lakh 50,000. Correct, Chris? Total of liabilities 28 lakh 50,000. Okay, then let's take up the next data. So we have current ratio now 2.5. Let's use this current ratio. Current ratio is calculated as current assets on current liabilities. Current assets upon current liabilities. And this current assets upon current liabilities ratio is given as 2.5. In the balance sheet, we have already computed payables and bank OD. Already computed the payables and bank OD. So we can get the current assets upon the payables and bank OD total up to what? 2 lakh 50 plus 1 lakh 50. 2 lakh 50,000 plus 1 lakh 50,000. This is 2.5. So we can get the current asset value as 4 lakh multiplied by 2.5. 4 lakh into 2.5. And that's equal to like 10 lakh. Current asset is 10 lakh. Out of current asset, we know what is the value of receivables. We don't know what's the value of cash. Anyways, so now we can get the inventory turnover. From this inventory turnover, we can get the value of inventory. And anyways, they're saying that its inventory is based on COGS. Inventory turnover. Inventory turnover is 12. How do we get this inventory turnover? This is COGS upon inventory. We have the information about COGS. We know the information about COGS. Cost of goods sold, yes, 22 lakh 50,000. That's 22 lakh 50,000 upon inventory. What's the value of inventory? What's the amount of inventory, guys? 22 lakh 50,000 divided by 12. Inventory is 1 lakh 87,500. Okay. Stock is 1 lakh 87,500. But we know that total current asset is 10 lakh. The total current asset is 10 lakh. And this 10 lakh is equal to stock plus receivables plus cash. The stock plus receivables plus cash. 10 lakh will be equal to inventory of 1 lakh 87,500 plus receivables of 2 lakh. Of course, you'll get the cash balance. Cash balance is how much, guys? 6,12,500. 6,12,500. Okay. And this total was 10 lakh. Of course, the total liabilities and assets should be same as 28 lakh 50. What is the value of the fixed assets? Fixed assets will be the balancing figure, which will be 18 lakh 15,000. 18 lakh 50,000. Got it, guys? Did we get this answer? Yes or no? Everyone? Are you able to solve this questions of ratio? Yes, half correct. Okay. So halfway you were true and halfway you were just uh, basically not such confident about. Okay. Anyway, so we did a good number of questions. Now, any query that you have right now, I'm just going to address it because with the remaining time, I don't think we'll be able to take up any question. Any query? Any query, any doubt, any formula that you need? Uh, yeah, 1 second. We have to discuss one really important aspect. Hope just got it collected now. The net profit transfer to balance sheet. Net profit is yes, balance transfer to balance sheet, but then that will be clubbed with the opening balance of reserves and opening balance of CN. Will the notes of ratio analysis be uploaded? Yes, it will be uploaded. Definitely, that's going to be uploaded. Okay, so we had two ratios to cover up, guys. One is called as the market value to book value per share, and another is the Q ratio. Now, what is market value to book value per share? First of all, we'll talk about what is book value of the company, book value of the shares of the company. Book value of the shares of the company is basically net worth or owned funds of the company divided by number of shares. So total owned funds that have been put into the business, you divide it by number of shares, that is your book value. So how do you know what is the owned funds that have been invested? Of course, we are talking of equity shareholders fund. So equity shareholders fund will be equity share capital plus reserves minus fictitious asset, or you can also say that it is assets minus outside liabilities, which is basically excluding the equity component. So let us say in the books of a company, equity shareholders fund stand as 30 lakh. Equity shareholders funds is standing as 30 lakh, which is the book value of the company. A book value per share of the company we get a book value per share of company, which is equity shareholders funds upon number of equity shares. This 30 lakh is the value of the equity, all the equity shares. Now, if I want the value of just one equity shares, I divide it by the number of equity shares. So that gives me a book value of 30. Now, this same share is trading in the market at a price of 36. So we can get this market to book value per share as 36 upon 30, which is 1.2. This 1.2 means market price per share is 1.2 times of book value per share. Market price per share is 1.2 times of the book value per share. Okay. Okay, so that's the book value. Now, how do we understand this? If the book value, I mean, if this ratio is higher, market price is also higher as relative to the book value of the share, right? So market value or book value per share is higher. So higher this ratio means the company is, overvalued in the market. Similarly, we have a Q ratio. Q ratio is market value of company upon replacement cost of the company. So replacement cost is what? Replacement cost is basically what is the cost that you will incur to make up a similar company or to build a similar company in today's era or in today's time. Okay. So higher this Q ratio means, of course, the company is going to be overvalued. So both these ratios If they are higher, they indicate a higher degree of overvaluation of the company. Okay. And so these are the two simple ratios that we were left out to be covered. So I just thought let me just cover it quickly. Will the notes be uploaded? Yes, it will be uploaded, Rishika. I'll upload this Excel file on the portal, which will be helpful for you to download it and also view that. Okay. Questions in the BOS, I have uploaded it. Questions. I don't know why you can't see it. Hmm. I have uploaded it yesterday. Anyways, I'll just do it. Notes, uni session, lecture of the topic. I'll just say this ratio analysis. Choosing the file. Yeah, I've uploaded it. Has been done. How to solve questions easily. Questions can be solved only once you are thorough with the formula. So all the formula should be properly understood logically, and also you need to be able to reproduce it. So that will obviously need some amount of time for you to remember. The only way to do is that just try to recall the formula every day. Once, well, like a doctor, I'll give you a prescription morning, afternoon, and then in the evening. Just recall all the formula quickly. It will hardly take around 10 to 15 minutes. So you do it 3 times, 3 day, 3 times a day for 3 days. All the formula will be learned by you. Then question solving will be a much easier task. Okay. Can we solve reserves and capital? Yes, you can. Isha, you can solve it that way also. That's absolutely correct. Okay, so with that, guys, let's just stop here for the day. Let's just stop here for the day. We'll meet up again in the next week with a new topic in financial management. Okay, let's just stop here, guys. See you. Bye bye. Good night, guys. Yes. That,